Is happening in the Bitcoin mining market, and it's starting to show up clearly in the data. Let's dive into what's actually going on and why it matters for both Bitcoin's price and the broader market structure. Recent on-chain activity shows that Riot Platforms has moved 500 Bitcoin. On its own, that might not seem extraordinary, but in the current context, it aligns with a broader trend across the mining sector. At the same time, data from Marathon Digital Holdings provides a detailed look into the economics behind Bitcoin production today. Based on Marathon's latest filings, the estimated average cost to mine one Bitcoin is around $70,000. This figure comes from a combination of inputs, roughly $31.3 per petahash per second per day, a total operational hash rate of about 50.4 exahash per second, and an average production of approximately 23.3 Bitcoin per day. What this tells us is that mining at scale has become increasingly capital intensive, with relatively thin margins at current price levels. At the same time, not all miners are operating under the same conditions. More efficient players, those with access to newer ASIC hardware and cheaper electricity, can produce Bitcoin at closer to $45,000 per coin. That spread is significant, and it highlights how much profitability depends on factors like hardware efficiency, electricity costs, power usage effectiveness, and geographic location. This cost pressure is now translating into observable behavior. Core Scientific recently sold over 2,000 BTC that had been accumulated since late 2024, and they're not alone. Multiple mining companies are increasingly selling portions of their reserves, either to strengthen their balance sheets or to secure liquidity in a lower margin environment. At the same time, there's a strategic shift underway. Some miners are reallocating capital toward AI data center infrastructure. The reasoning is relatively straightforward. Bitcoin mining is becoming more competitive and margin constrained, while demand for AI compute is growing rapidly and may offer more stable returns using similar underlying resources, particularly power and cooling infrastructure. From a market perspective, this creates an important dynamic. Bitcoin's price is currently hovering around the average cost basis for many miners. That effectively becomes a pressure zone. When prices are near production cost, miners are more likely to sell into the market rather than accumulate, which can increase short-term supply. Meanwhile, lower-cost operators can continue mining profitably, creating a divergence in behavior across the network. For investors, this is where things become particularly relevant. Miner selling can act as a headwind during periods of price consolidation, but it can also serve as a signal of underlying stress in the system. At the same time, the shift toward AI introduces a longer-term change in how mining companies generate revenue, potentially reducing their direct exposure to Bitcoin over time. So the key takeaway here is relatively clear. Mining is no longer a uniform business with predictable dynamics. Costs are rising and diverging, miners are becoming more active sellers, and capital is starting to flow into adjacent sectors like AI infrastructure. And that raises a broader question going forward. If mining companies are no longer purely aligned with Bitcoin accumulation, how does that reshape supply dynamics over the next cycle? That's the trend to watch.